What's going on, everyone? Welcome to another video. Super excited to be here today. Today is Monday, November 14th. Huge shout out once again to App Economy Insights for this amazing data. In today's video, I want to talk about a couple of option strategies you could use on a couple of these marketplace players. I'll go into which ones I think are the best to play some option strategies on, and which ones I'd probably avoid, just given some of the graphics here. Real quick, want to give a quick reminder. If you could like and subscribe, that'd be amazing. This is a brand new channel, so I'm working hard to make the content better, get the equipment upgraded, so really would appreciate any support that you could provide. Like I said, I want to give a huge shout out to App Economy Insights. I totally love their graphics, these visuals, they're unbelievable and super helpful for me to kind of give me a basis on which companies I want to look into and which option strategies I can utilize for these different companies. So real quick, in today's video, like I said, I'm going to focus on these online travel marketplace companies. A lot of them don't actually own any physical real estate locations, but they are the facilitator. So I'll quickly run through the big four, let's say. First up is Airbnb. I'm sure everyone's heard of Airbnb, and it's actually my favorite out of these four. As you can see, revenue for Q3 FY22 coming in close to 3 billion, and it's up 29% year over year. And if you look all the way to the right at the net profit, they have a 42% margin on their profit, on their revenue. That's unbelievable, and one of the highest of the four that we'll run through today. The next one that probably comes to mind for everyone is Bookings, Bookings.com, Priceline, etc. They have a little bit more revenue, closer to 6 billion, up 29% year over year, with a net profit of 1.7 billion and profit margin of 28%, which is a little bit lower than Airbnb. What's interesting about Booking is it's actually not one of the ones I'm going to recommend to use for an option strategy. I'll get into that in a minute about why. The third one, which is the second one that I'm actually going to focus on when I get to the option aspect, is Expedia. Expedia has 3.6 billion quarterly revenue, up 22% year over year, has a net profit of only $500 million and a 13% margin, which is actually unchanged. So this is the second one I'm going to focus on. And the fourth one, TripAdvisor. Personally, I'm not going to even look at this company because for options because of just the financials. It's very small compared to the others. Net profit is much smaller compared to the others. Overall margin is 15% on operating profit, and only 5% on net profit. So it's not going to be the ones that I focus on. So the two that I'm going to focus on are one, Airbnb, and two, Expedia. So now jumping into just super high level about the companies. One of the reasons I picked those two is because if you actually look at Bookings, the stock price is extremely high, $2,000. And if you want to sell a put, which is the strategy I'm going to focus on today, you're going to have to, in theory, be willing to own or buy 100 shares of Bookings. So if you were to get assigned a cash secured put, which I'll get into that in a minute, you would have to have effectively $200,000 available and ready to purchase these shares. My favorite out of this category, as you can see here, current price is about $110, 52-week range, $86 to $212. Price earnings ratio is high, it's almost 40. Earnings per share is $2.76. And here you can see 5-year chart, although they IPO'd in 2021. It has been trending down, but you could see in the last, 6-ish months, a little less than 6 months, it's kind of stabilized here. If we go to the 6-month view, yes, it's red, but you can kind of see it's kind of stabilizing somewhat here. The next one I'm going to focus on today is Expedia Group. So Expedia Group here, you can see the price is 102, so very similar to Airbnb. Market cap here is 16 billion. Price earnings is 33.5, so fairly close to Airbnb's. Earnings per share is a little bit higher than Airbnb's, is at $3.06. Looking at the 1-year chart here, you can see it kind of has a similar trend down, and now it's somewhat stabilized over the past 6 months. So this will be an interesting one to look at. The 1-year target estimate, according to Yahoo Finance, is $130, and on Airbnb, it is close to that $133, which you can see here. Now, jumping into option strat, I want to walk through a couple of options that you could do, and particularly the cash secured put on Airbnb and Expedia. So in option strat, you can click on build and then go to cash secured put. Now, to quickly answer the question, what is a cash secured put? One, it's an income producing strategy. Note, it does have limited profit and unlimited risk technically. Effectively, a cash secured put is you are selling the put option and someone is buying that put option. So you are saying, hey, pay me a specific amount of premium today and I will potentially buy the stock down the road. So the person buying the put on the other end, they have the right to put you the stock at any time at the strike price that's agreed upon in the option that you sell. So I'm going to click on cash secured put and I'll walk you through an example with Airbnb. Clicking on this, typing in Airbnb, and then jumping to the chart. So as you can see here, current stock price is 105, and I selected December 16th. It auto defaulted to that, which is 32 days from now. So I'm just going to start as an example at the 105 put. So today, if you were to sell a 105 put, cash secured put for Airbnb, you would have to have collateral of $10,500, but you would collect $638 today. And what that means is in 33 days from now or 32 days from now, whoever's on the other end of this option, they have the right to put you 100 shares of Airbnb at $105. So they are paying you effectively the $638 today to have that right to put you those shares 32 days from now. So in theory, if Airbnb drastically drops to 80, the individual who bought that put, they can give you Airbnb at 105 while the stock price is 80. So that's where the risk is, because you'll be put the stock at 105 when in reality it could potentially be 80. So that's the risk that you expose yourself to. So for example, with Airbnb, the approach and strategy that you could take is potentially picking a strike price a little bit lower at the bottom of the range of where it's been for the past 6 months. So maybe going down to a 90, about $15 below its current strike price. If you sell this put today, 1 month out, you could collect a net credit of $166. And it's important to note here you can see the chart of what the income premium will look like across different days according to the stock price. So here, if the stock is 115 in 32 days and you sold a 90 put, you'll collect the full amount of the premium, $166. The option expires worthless, and the collateral that you put up for this trade, the $9,000 here, nothing happens. But if the stock price goes down to, let's say, $88, I'm going to make it a little bit more longer. So if the stock goes down to 91, 85, let's go to 85. Here in this example, you'll be down $334. I will say this is a little misleading because in theory, if the stock price is down to 85 and you sold a 90 put, the individual who bought this put, they may assign you these shares at the end of this trade. So yes, you'll be down 334, which is the delta between 90, 85 plus the premium you received, but you have to consider that you could be put these 100 shares of Airbnb at 90 while it's currently trading at 88. So the $9,000 in collateral, will be exercised and could potentially be taken away, and you'll now have 100 shares of Airbnb. So a couple things to keep in mind. Looking at, let's go all the way down to 80. Here, it gives you this notification that it's a wide bid-ask spread, so it may not be an optimal trade, an optimal strike price. So let's go back to the 90, and I quickly want to walk through some of the Greeks. So from a delta perspective, so this is really what's the percent chance it'll expire in the money you're at. So here it's about 16%. So it's a lower chance. So you also have to think about risk and reward. Is $166 in 1 month after putting up $9,000 of collateral worth it? Potentially, potentially not. It's about almost 2% of a return. If you annualize that, that's a 22% annualized return. Um, so it's not a huge return, but it's a little bit conservative if you consider where Airbnb is trending the past 6 months. And if you want to own the stock and you're confident in the industry, then it could be a great purchase price for you. The last option Greek to talk about is theta. So here, this is effectively time decay. So every day that the option stays at, let's say, 105 of the current strike price, the option premium will go down by $6.85. So effectively, the option will eventually be zero, losing $6.85 every day, assuming that the stock continues to maintain 105. So that's the high level of Airbnb. The second stock I would select from this group is Expedia.com. So I'll jump over to Expedia and quickly show you a chart here in their data. So like I said, over the past 6 months, kind of stabilized. Going to the chart view here, I'm going to scroll up. You can kind of see where it's stabilized since July. It's kind of been hovering in this, 90, 100 range. In this range that you're seeing with the yellow bars, that's called the Bollinger Bands. It's more of a technical analysis you can use. I'm not an expert when it comes to technical analysis, but it's another tool I like to have in my toolkit to kind of gauge stocks performance. So as you can see, it's definitely stabilizing somewhat over the past 6 months here. So again, this is why I like this stock, and I like using the cash secured put strategy for this stock. Now, jumping over to Expedia, I'll quickly walk through an example cash secured put here. For this company, you can see the current stock price is $98.62. It's defaulted to December 16th expiration date. And here you can see it's low volume. It's because it's aftermarket, pre-market per se. But looking at this example here, if you were to select a 95 strike price, you would collect $405 in premium, and you're effectively putting up $9,500 of collateral. So that annualized is about 51% return. So that's assuming if you sell a cash secure put on Expedia for 95 on December 16th and do this every single month, not on December 16th, but every single month, you'll get annualized a 51% return. There's no guarantee that you'll be able to get this type of credit and it'll expire worth this every single time. So this is where it's important to pay attention to where the stock is trending and where it's been, and if it's overbought or oversold. So another conservative example here is if you go down to, let's say, the 80 strike price. So this is almost 20% lower than the current price. Here, if you sell an 80 strike price cash secure put on Expedia, you'll get a net credit of $79. It may not seem like a lot, but when you take a step back and you collect $79, putting up $8,000 of collateral, if you annualize that, that's almost a 12% return. In my opinion, this is somewhat conservative. Do you think Expedia, with the financials I showed at the beginning of the video, will drop another 20%? Potentially, yes, potentially not. So those are just a couple things to consider. Also, definitely keep in mind risk and reward. Is 12% annualized enough for this type of company? Maybe you want to do this cash secured put on a more stable company that's been around for significantly longer. Just things to keep in mind when you're selecting which stock and what strike price to sell cash secured puts on. Like I mentioned in previous videos, feel free to grab the link below to Option Strat. There you can sign up. I really love this tool. I highly recommend it. Links in the bio below. Feel free to check it out.